seen the point solution market develop over the last decade. And some of these companies did very, very well financially for themselves. Some of them went public, some of them sold for huge numbers, and the investors and the employees did great. But a lot of these benefits did not drive the intended outcome for the benefits leader.
Yep.
I would argue less than 10% of solutions implemented at the point solution level had driven the intended outcomes and driven the intended value.
You're listening to Self-Funded, the podcast about making healthcare better together. Let's get to work. Well, what's up, Norm? How are you?
I'm great. Glad to be in Dallas.
Yeah, well, I want to give you a chance real quick to introduce yourself. And maybe if you give us a high level, hey, what are we going to cover today other than Cleveland is brutally cold in the winter?
It is.
I know
I'm
that'll
glad
be part
to be here.
You're in Texas, and it's going to be 81 degrees today in November, which is awesome. But give me a little bit of an insight, especially for the audience. Yes. What do you think we're going to cover today?
Yeah, so I'm managing partner at DRI, recruitment firm. I started the digital health and employee, wellness practice about 10, 11 years ago.
Okay.
And then in the last couple of years, I've actually moved to the venture capital world as well. Still run the recruiting firm on the digital health side, but we saw an opportunity to support early stage companies, helping them with their commercial go-to-market. So that's been a really fun project. And I founded MVP Growth Partners along with my business partners, Manny Menendez and Jason Perot.
Awesome, which is, I think, the reason why you're down here too. And I appreciate you making the stop over here in Frisco to do the show, man. And you had me on your show a couple months ago as well. I missed the boxing gloves, man.
Yeah,
you didn't bring them.
I don't bring the boxing gloves unless we're doing the heavyweights.
Yeah,
so.
Fair enough. But I think one of the reasons I'm really excited about this is, like, of all the couple hundred people I've had on my show, you probably have some of the best insight of what's going on into healthcare writ large, right? So what are the innovations, what companies are doing well, what categories are struggling, et cetera, et cetera.
Yeah.
And I think your transition from being just in the healthcare recruitment space to now in the venture capital space and still maintaining both, that's really, really going to be interesting to the audience, at least in my opinion. So let's go into where you started first, because you didn't just wake up and get here. What's your background in recruiting? How did you get into that?
Yeah, I wish I could say all of this was intentional and well planned out, but that would just be lying. So I'll be super truthful. So in my career, I started right out of college at this firm. The team I joined was hospital IT recruiting. They were already very good at that. I was joining an already very successful practice. So I really just tried to be a sponge. I tried to learn as much as possible from my boss, who was like the guy in that space, still is to this day. So within my first couple of years, I became the top recruiter on the team. But I also noticed for my career progression, I would probably kind of cap out at number 2 on the team if I stayed just focused in that. So I sat down with my boss at the time, now one of my business partners, said, Mike, I love recruiting. I've learned so much from you. It's been an amazing experience. Don't want to leave either the firm or healthcare for that matter. But I really want to build something of my own.
Yeah.
What can I do in healthcare that doesn't step on your toes? So he said, well, our clients implement software inside the 4 walls of a hospital or a provider group. How about you focus on outside the 4 walls?
Okay.
And that was for, 13, almost 12 years ago, maybe. So for the first couple of years, it wasn't a clear path to where exactly I would focus. There were telemedicine companies, there were remote patient monitoring companies, but the ones that sold to hospitals were growing very slowly. They weren't experiencing explosive growth. When you're not experiencing explosive growth, you're not going to make a ton of hires.
Yep.
So I had some really good clients, but they weren't bringing me a ton of volume yet.
Okay.
So I go to a HIMSS conference. It was in Vegas many years ago. And I remember meeting someone named Jim Pursley. He was chief commercial officer of a very small company at the time. But before that, he was at GE. He was, I believe, at a joint venture between Intel and GE, telemedicine play. And that little company at the time was called Livongo.
Okay.
And they had, I think, maybe 30 employees at the time. And the only reason the company was on my radar is, number one, it fit what I was directed to do, delivering healthcare outside the 4 walls of a hospital, diabetes management. And 2, their executives all came from the hospital software space. So Glenn Tolman, Lee Shapiro, they were at Allscripts, a EMR company that was directly like in our market. And the EMR companies were kind of like the hubs of all technology in the 4 walls of a hospital. Everything had to plug in to that EMR. So when he described what he was building, I was all in. I'm like, this is my ideal client. So I stalked them a little bit for many months. And then I get a call from Jim. And he goes, well, Norm, your patience and persistence has paid off. We need to make 10 hires. And you're the guy we want to help us. I'm like, fantastic.
Yeah.
What do you need? It's like, well, I need 2 health plan sellers. I'm like, great. I've actually done a handful of those. Some of our clients that sell to hospitals also sell to health plans. And guess who gets to work them? Me, because they're the toughest searches we work on. And we've been effective at doing those. How about the other 8? What type of hospitals you sell into? What territories? He goes, no. We're not selling hospitals. We're selling to employers. I'm like, Jim, what is that?
Yeah.
And he educated me. He's like, well,
how long ago was this again?
This was probably 11 years ago. 11 years ago. Okay. At the time. They had, some traction. They had some employers. They're doing well. They had a core team. Many of them came from that Livongo or Allscripts family tree. And they were starting to want to expand and get some people who had industry experience, people who had sold to benefits for a long time. So he explained it to me and I said, Jim, I'm not going to bullshit you. I've never done a search like that. I think I can, but I don't want to lie to you and say, I've done it. I haven't. But if you give me 2 to 3 weeks, I will work my ass off and I will prove you right. For betting on me, I just need a little bit of coaching. Tell me about a couple companies you want talent from. Tell me a little bit more about the value prop and the unit economics and how this makes logical sense for an employer. I'll figure out the rest.
Well, so you seem surprised in retelling that story that he wanted to find people that could sell to employers. Why is that, right? Like, did you understand the vision of why they were positioning it to employers?
I did.
Okay.
It made a ton of logical sense. Thus, I was willing to invest time and resources into building out this new space.
But was it novel at the time, positioning to employers that type of solution? Or
it
what?
was, for me, a completely new market.
Okay.
He did describe, hey, there are sectors within this space that have been selling employers for a long time. And he explained the wellness companies and some of the other groups. And then there were these new age companies like the early adopters, like Livongo, like Omada, like Big Health, like some of the mental health companies that were starting to do niche point solutions, as they are called today. So it was definitely a new thing for me, but he was also describing, well, Norm, you're in luck. You might not have experience doing this, but I don't think many other people do either.
Fair, yeah.
So we got to try with someone, and I like your style. I like your enthusiasm. And
it's safe to assume you were successful in that search.
We were successful. Within a couple months, we had won their exclusive business. Anytime they looked to hire someone on the commercial team externally outside of their internal team, we were lucky enough to be their sole representatives in the market for top talent on the employer and health plan side.
Hey guys, I want to take a moment to tell you about Samaritan Fund Program, because what they're doing right now is incredibly important for employers and brokers. When an employee faces a serious medical event, the financial stress alone can be devastating. Not just for the family, but for the company as well. Productivity drops, morale suffers, and healthcare costs can skyrocket. Samaritan Fund Program steps in during those moments with direct financial support for the employee, helping cover life's real expenses when they need it most, while giving employers a powerful tool to manage large medical claims and overall benefit costs. It's more than just assistance. It's peace of mind to heal. If you're an employer or an insurance broker looking for a smarter and more compassionate way to protect your people and your bottom line, learn more at SamaritanFundProgram.com. And now, was this the time frame when this idea of merging VC or venture capital with recruiting came into play, or no?
It happened many years later, and I can kind of describe that, but it was certainly the catalyst for it. And, we'll talk more about that.
Yeah, so out of curiosity, because I've always sort of sold through the consultant space, whether that was stop loss, wholesaling it, plan side RFP software, now Pareto, the benefits captives. But when you're finding talent that has the ability to sell vis-a-vis that persona, what are you looking for? What makes a good salesperson, either direct to employers or through brokers? Why don't you describe them for me?
Certainly subject matter expertise is important, having contacts. So yes, knowing the end benefits leaders, knowing the benefits consultants and brokers, knowing the carriers, knowing the PBM folks. It's a very delicate ecosystem that we've described as sometimes incestuous. So, knowing how the game is played and everyone's incentives and who are the stakeholders in these deals are very important, and how to navigate those. Outside of that, I tend to work with companies that are on the come up. They're early, they have a great novel concept, and they're trying to evangelize that mission in the market. So outside of contacts and success and hitting quota and all the things every company looks for, you're looking for people that can articulate a new concept, sell a vision, sell the future, sell what healthcare should and could be in the future. And it's been really fun over the years to be able to support these companies from the beginning and watching them grow. So watching Livongo go from a, how do you pronounce that, to being an IPO company that everyone knows about.
Right.
Interestingly, a really huge part of what got us off the ground in this space was not only Livongo giving us the opportunity, but during that search, I approached it as, I obviously want to come through for Livongo, but I also want to put my flag in the ground and saying, hey, Norm's an employer tech and he's here to stay.
Yeah.
So in that approach, and it was also in the best interest of Livongo, because I do think it acquires a better quality candidate by recruiting this way, I was calling leaders of other companies, CEOs and chief commercial officers and sales leaders. Hey, I'm working a search for Livongo. They're looking for these skill sets in these territories. I have a question for you. If you were in my shoes, who would you talk to? Who are the best people that you're aware of? Who are people you've interviewed in the past that you were very impressed by? Who are maybe your competitors' top people that if I helped them move into diabetes, it would make your life a hell of a lot easier. So by not only recruiting by calling high and getting referred low, thus getting a higher quality candidate as a result for Livongo, they also were thinking in the back of their head, wow, I really like Norm's approach. He sells the crap out of Livongo. Like, I wish my recruiter sold my company that way. Why wouldn't I use Norm?
Right.
So within a couple of months, Livongo is not my only client in the space. We had worked with Big Health, Hello Heart, Vita. And right around that time when I was actually telling my firm, guys, you got to backfill me. I'm happy to replace myself. I'm happy to train my new hire. But I think this space is going to be keeping me plenty busy. And I think I'm going to eventually have to hire a team to meet this demand. Because I saw like Livongo was not just one company succeeding. There was actually a lot of companies primed to have a lot of success. So maybe 8 months after I first started recruiting for Livongo, I get a call from Jim again. He goes, Norm, I need your help. I'm like, Jim, you're my top client. I'll run through a brick wall for you. What do you need? He says, well, I'm helping these two entrepreneurs. They started a business doing their doctorate thesis, getting their PhD, and I really think you can help them.
Okay.
I said, okay, tell me about the business. He's like, well, they do digital MSK. I did not want to sound like an idiot, so I just kind of nodded my head. I said, okay,
and then
that
Googled
sounds great.
MSK.
And I Googled digital MSK, nothing popped up. And I said, all right, I can figure out digital. What is MSK? And musculoskeletal and chronic pain and, physical injuries like starts popping up. And I'm like, oh, this is interesting. It's not wellness. It's not diabetes. It's not mental health. How does this add up? How will this be sold and packaged to employers? So I was a little skeptical, but I said, hey, Jim's a good guy. I'll take the call. Happy to spend time with these folks. And that was Dan and Gabriel at Hinge Health when they had a couple pilots, they had one salesperson at the time, and they explained the vision of what Hinge Health was going to be. And they wanted me and my team to evangelize Hinge Health in the talent market. And that was the first company we met that at that point was really unknown. I would say at least 9 out of 10, probably even 19 out of 20 people I talked to on behalf of Hinge had never heard of the company before. And I explained, hey, this is a company on the come up. They have a great value prop. They offer great service and value to the employer. And this is going to be one of the top benefits in the next 4 to 5 years. Luckily, my belief in them was correct, and it built a lot of credibility. But that's what really put our name on the map and allowed us to start bringing in great other clients like Lyra and Verta and Progeny and Carum and Right Way. We've been lucky to work with, probably over a dozen unicorns.
Well, it's funny, all of them I know by name, right? And some of them we even do business with. But out of curiosity, so you had 2 obvious success stories with Livongo and Hinge.
Yep.
Looking backward, Was there something about each of those organizations that you could tell there really was something there and they weren't just an also ran or a fly by night that would fail? Like that's 2 for 2. So like there had to be something that you detected.
Yes. Again, there are similarities and differences between founding teams, between leadership, between value props and how they go to market. But what I think really was similar about both is strong conviction. Brilliant leadership teams, ability to articulate a value prop very simply, but also creating a complex system to drive results. So that combination of intellect, drive, and ability to articulate very, let's just say, complex concepts and really make it understandable to someone at a 3rd grade level, that's the skill, is being able to build something extremely complex, but able to explain it in a very simplified
synthesize
manner.
it. That's what I've heard is like you synthesize the complex into the simple. So in a couple months, I'm going to have a gentleman named Billy Potter on, which is a phenomenal consultant. I heard him at one of our Pareto kind of like sales conferences say that people don't buy what's best for them. They buy what they understand the fastest. And it's exactly what you're describing is a founder's ability to take something really complex, articulate it, distill it down to the most simple form. And you go, I get that. I understand what you're selling.
And they're
me.
able to do it because they're subject matter experts in the field.
Yes.
And that's what I found really interesting about Glenn and Jim at Livongo and Dan and Gabriel at Hinge. They got into a meeting with a big Fortune 1000 benefits organization or a benefits consulting firm or a large carrier. And even if they were in a room with 20 high-ranking officials from a much bigger company, no one was going to stump them when we're talking with Livongo on diabetes.
Right.
Or an MSK with Hinge. And that combination of subject matter expertise and passion for driving change is what built that trust and built that belief that, hey, this company is going to allow us to provide a better healthcare experience for our employees.
Was it Hinge, the one that when you sat down and saw their presentation, like you were just blown away by the presentation itself?
I was blown away by both, but I would say we caught Hinge earlier in their growth. So they were the first company that I'm like, I've never heard of them. My network's never heard of them, but I'm looking at the future. I'm seeing something that will be one of the biggest organizations that will exist in this space, even though I was pretty new to the market. I remembered in the back of my mind, I met Dan and Gabriel and thought this company's going to be worth hundreds of millions. The first time I met him.
Wow.
And I sold him short. They IPO'd for well over $3 billion recently. But it did give me this like goosebump moment where I'm like, I'm going to invest every ounce of energy to help these two build this company because their success will also be my success. And that can propel me to the next level within the recruitment field. And you asked earlier, like, when did the ideas bubble into my head about VC? It really was me reflecting on those two companies in the early years. And really thinking to myself, at any point in meeting these folks, especially in the first couple of months, did you have any reservations that they wouldn't achieve massive success? And I really said to myself, no. And then I asked myself, well, why didn't you invest? Why didn't you ask to invest? And honestly, number one, I didn't have the capital at that point.
Fair.
And two, I just didn't know to ask. It was me just being new to a market and not even thinking there are other ways to participate in the growth of the space. So I did sit myself down kind of one-to-one, looked in the mirror and said, well, next time you get as excited as you did about Hinge when you first met them, at least ask. The worst they can say is no. And that's actually led me on the path I've been kind of following the last couple of years.
Well, so I would be
But
remiss.
there were 8 years in between of me iterating and learning till I felt, hey, I have enough knowledge, I have enough information, I have enough relationships in the space to really do this at a high level where it's not only in my best interest, but more importantly, it's in the founder's best interest to get me involved.
Well, and I'm glad you said that too, because when people will come on and recap their bio in 5 minutes, it's like, it sounds like it was a split second and all these things happened. There's years and years and years. And that's, you're building your network, you're educating yourself, you're becoming more experienced, you're maturing, all those things then make the next step possible. And I think that's really important for young people that are early on in their career to understand that to get to where a lot of people that you hear or see has been decades possibly to get there. And so don't forget that.
Healthcare costs keep rising. Quality of care feels inconsistent. And for many employers, there's no clear picture of what's actually working or why. At Valence Health, we believe there's a better way. one that simplifies healthcare to reduce costs, improve quality, and elevate the entire care experience. Using an interconnected strategy, we unite patients, payers, providers, and plans to break down the healthcare silos of old. The result? Meaningful innovation that optimizes the cost, quality, and utilization of healthcare for all. Our fully integrated platform of solutions engages early and often to improve health literacy and data-driven decision-making across the entire healthcare journey, from member experience to payment integrity, provider quality, and plan performance. Together, let's create a smarter, better, faster approach to healthcare. Visit valenshealth.com to get started today.
But one thing I want to ask you, Norm, before we move on, we hear the term VC, venture capital. People hear PE, private equity.
Yeah.
Really quickly, in your words, what's the difference between those two?
Yes.
Yeah.
The way I look at it is venture is investing in very early stage businesses that are trying to transform a sector or a market or a specific niche. PE is identifying companies that have more potential than they're performing today. And by having a very sophisticated leadership team, creating efficiencies in a business that is already receiving a ton of success. And they just believe, hey, with our knowledge, with our playbook, so to speak, we can take an already successful business and make them more profitable.
Right.
VC is more catching the diamonds in the rough before anyone knows there's
I'd imagine
there.
it's more unpredictable in nature. But
way more volatile.
Yeah, maybe volatile, but obviously earlier stage, so valuations are lower. Participation, could be less money overall, and might be more people could participate that are at that level of being able to invest, tens of thousands, hundreds of thousands of dollars. But you don't know what's going to happen either, which is perhaps the exciting part of it, because it could be a unicorn or it could be a dud, and you just don't necessarily know.
Very true. Historically, if you're in PE and even a third of your companies go to zero, you're probably out of a job.
Okay.
In VC, if 50% or 70% of your companies go to zero, as long as you have a couple winners in your portfolio, you're actually considered a success. So I would just say the conversion rate of investment to meaningful return in PE, you got to hit it every time. And just to what degree are you succeeding?
Fair.
In VC, it's much more, in general, shotgun approach. Make a lot of investments, place a lot of small bets. You don't know which ones are going to hit. And by the power law, if you have a couple winners, it can mask all the losers.
But it's exponential, right?
But it's exponential. So again, very different business models. I actually do VC a little more uniquely in that I want to have a very high hit rate, and you got to be really particular and do a lot of due diligence and turn down a lot of business and deals that have promise but might not fit your thesis. So again, we're almost creating more of a PE standard for success rate while also investing in the earliest companies, which is a very fine line to be able to walk.
Well, okay, so obviously in theory, that sounds fantastic, and I would agree with your thesis. How do you actually stand that business up? How do you go from recruiting to having a VC arm or separate business that feeds one another?
That's a really good question. So again, I told myself maybe 5 years ago when I started to see this pattern recognition of companies succeeding. And again, I am in a very unique position because my team of 12 at DRI, they all focus within digital health and benefits.
Okay.
So we have access to an amount of data points that almost no one else has access to. And why we're able to is because we recruit on all areas of a business. So when we work with a client, we're not only building their executive team and their commercial team, we're also placing their customer success and account management teams and leaders, marketing, product, finance, technology, legal, engineering and development, clinical. So you see, all right, what companies do great, what companies don't do great. Why do they do great or why don't they? What pricing models are in? What type of companies are driving more value for their employers than the average company? What type of models are working really well? Which companies are getting a really strong ROI for their product and actually are saving the employer money, thus generating a lot of success. So we started to see all these trends of which companies are set up to succeed, which companies are kind of set up to fail based on a lot of different independent variables. So I meet a founder at Health about 2 years ago, a little bit over.
Is that the health conference?
Health conference in Vegas.
Yep.
And it was actually at the opening reception. The conference hadn't technically started. The booths were being set up probably while we were out there. And I meet a founder that described to me what he was trying to build. And it gave me goosebumps. It reminded me so much of the conversation I had with Dan and Gabriel 8 years prior. So what he described to me was a carve-out radiology network, COE model that allowed direct contracting between employers and providers, cutting out the health plan middleman. And why that immediately resonated with me is because two of my clients, Carve Health and Progeny, had already set up these models in different service lines. So Progeny and a lot of their competitors, Carrot, Win Fertility, Maven, Kindbody, they all saw that the fertility market was an inefficient market. And what they created is these carve-out networks that allowed employees of organizations that sponsored that benefit to get better access at better cost to fertility treatments. And those companies have all done very well. Progeny IPO'd, I think at their peak, they were worth over $6 billion. And Carrot's been valued over $1 billion. Kindbody has been valued at over $1 billion. Maven's been valued at over $1 billion, in public, news clippings. So that market was the first market to kind of disrupt the traditional provider network. Then the Carums, Lanterns, Transcarent, formerly known as Bridge Health, like that division, those companies iterated and did the same model for surgery and have since moved into cancer treatments, and some of them have moved into substance use disorder. So again, we saw, all right, it works in fertility, it works in surgery, cancer, now substance use disorder. And what he's describing is the same model for radiology. And what really struck me is a couple things. First, those first two models does require the patient to travel a significant amount. Nice thing about radiology is it's pretty present in most communities. So no need to get on an airplane for this service. The other piece, Elon told me 51% of employees need an imaging scan per year. So what do employers like? Offering a benefit that improves the lives of many of their members, not just a select few. And the other piece that I found very interesting was there is almost no correlation between price and quality in radiology. You can get, again, we're in Dallas, you can get an MRI at Baylor Scott and White, and that might cost $5,000 for the health plan, self-insured. You can go down the street and get that same MRI for $450. Same machine, same quality of image at a fraction of the price. So site of care is the only determining factor in price. So what One Imaging was doing was they were aligning their patients to go to the most cost-effective but highest quality sites of care to get their imaging scans. So I'm like, all right, huge volume, huge cost savings per scan, and zero clinical differentiation between the scans itself, as long as it's on the same
not to mention
equipment.
It's set up with a $0 incentive to the member, correct?
Correct.
Right, that's the other piece that people often miss is how do you encourage adoption of something, even if there's even a slight inconvenience to go here instead of here, waive their out-of-pocket cost completely, give them the financial incentive.
And a better patient experience. If you go to an acute care facility and you have an appointment for an MRI, guess what? If someone from the ED needs to check out their broken arm, you're getting skipped. Someone had a surgery and a complication, you're getting skipped. You could be waiting in that chair for 2.5 hours. If you're taking your lunch break to go get your MRI, all of a sudden you got to take the afternoon off from work. If you're scheduled at an ambulatory imaging center, you actually have an appointment like it's any other business. And you get in, you get out, you get your scan, no copay, and you're back to work. You're back to your family, and very easy.
And what you're describing, and I think it could be repeatable in other types of services, is the way that we all, as Americans, I think healthcare should operate. It should be relatively seamless for an appointment. It should be cost effective. It should be simple to set up that appointment, go to it, and return to work. The employer should benefit based on the arrangement they've established. It's healthcare in a real free transactional market without insurance being inserted in.
Their aspiration is they want it to be as easy to book an MRI that it is to book an Uber. And they're getting there. And it's, driving amazing NPS scores, and employees are thrilled. We've even had a benefits leader of a major Fortune 10 company book a imaging scan themselves, and was like, this is the best experience I've had with a digital health app I've ever seen, and they've implemented dozens. So I would just say, again, we got on a tangent here.
No, but I'm glad
when I met Elon Adler of One Imaging, founder, he pitches me this great idea. I get the goosebumps. Oh my God, I'm looking at the future again. And I say, Elon, this is going to catch you off guard. I know we just met 5 minutes ago. I want to tell you two things. First, that's the best early stage pitch I've ever heard from a direct to employer digital health company since I met Dan and Gabriel at Hinge Health 8 years ago. Two, I want to invest. And he looks at me and goes, Norm, you're a recruiter. You're not a VC. What are you talking about? So I explained, hey, I've done a little bit of investing. I'm an LP in a couple of funds that I do a lot of business with that I respect a ton. And I totally understand that this is unusual, but I am of the belief that if I can invest, I can drive a lot more value for you and your company, because my contacts, my knowledge, my relationships in this market can help you in a lot of ways other than getting the best butts in the seats you need. So he said, okay, that sounds great, but I need to see it. I can't just take your word for it. So that's fair. So let me do this. Let me make some intros next couple days, and you tell me if these are helpful intros or not. So I thought to myself, all right, what are the companies that would probably either partner or be at least tangential to imaging? So I thought to myself, all right, let me make intros to organizations that might be able to make 1 + 1 = 3 or more here. So within 2 days of meeting Elon, he's talking to the COO of Carum, Chief Commercial Officer, Transcarent, VP of Product and Innovation at Progeny, VP of Partnerships and Corp Dev at Hinge, commercial leadership teams at Lantern, Sword, head of all channel sales at Livongo Teladoc, and then Steve Blumenfield at Willis Towers Watson, Kevin Fiak at Aon. Within a couple of days, I get a text from Elon. Yeah, we'll take as big of a check as you want. You're in. We want more of this help, which was great.
Pareto Health is the largest benefits captive in the United States. With nearly 3,000 captive members, $1.3 billion of stop-loss premium in force, and almost 1 million covered lives, no other benefits captive comes close to Pareto Health's scale. But it's not just about the numbers. Pareto Health is a mission-driven organization, and that mission has two distinct parts. Number one, to make self-insurance simple and more accessible for small to mid-sized employers. And number two, to arm them with the most powerful cost management tools on the market. So if you're an employer frustrated with your healthcare outcomes, or you're a benefits consultant looking for an alternative to the status quo, it's time to consider Pareto Health. Pareto Health, where employers come to do self-insurance right, to do it easily, and to do it at scale. Yeah, but I think the other side of that too is you now had 8, 9, 10 people help evaluate the business from their vantage point as well to, again, prove your response, this goosebump response that you got to say, you're not alone in your vision for this company. Like, we see it too.
Yes.
Right? Yeah.
So I was very beneficial to be able to get the opinions of experts that I respected their opinion quite a bit. And yes, it made me a hell of a lot feel better about writing a check, allowing me to write a bigger check and feeling comfortable with that. And eventually, I invested at their pre-seed, at a very low valuation, and that's great. But what I didn't love is when I asked Elon, hey, could these other people invest? He's like, as much as I wish I could, I can't complicate my cap table. You only can have so many individual investors, and I really got to keep my cap sheet clean because the next investors might not invest if it's too complicated.
Makes sense.
So I said, okay, but what if we created an SPV in the future? Is that an option?
What's an SPV?
Seed. So essentially it is a separate entity, essentially an LLC, in which investors can all invest into that LLC, and then the LLC invests as one entity into one private company.
Makes sense.
So he said, yeah, that's an option. Let's talk about that over time. So because I knew that that was at least an option with One Imaging, but I knew eventually it would be an option with others, I started to just, again, do a little bit of research and confirm what I already believed. So what I did was I reached out to every founder of a digital health company that I could think of that had scaled their business to over 100 million in valuation. And I asked them the same 3 questions. First, how helpful were your early stage investors in introducing you to customers and resellers? The general consensus was not at all.
Okay.
Maybe got a couple helpful intros, but it was very mild at best. The second question I asked was, hey, you've been to the mountaintop that a lot of these other founders are trying to climb. How often are you asked to advise or sit on boards of early stage digital health companies? And that was very, very rare. There's a handful. There's the Jim Pursley example where he was an executive at Livongo and advised Hinge. There's the Gabriel Mecklenburg example. He founded Hinge, scaled them, is an advisor to Pelago Quit Genius.
Okay.
And that's actually how I get some of my clients is good clients recommend me other good clients.
Yeah.
So there are a couple examples, but most of them said no, not at all. And then the third question I asked was, how often do you get to invest in early stage deals you're excited about? And they said, absolutely never.
All of those responses are surprising to me.
It is.
Yeah.
It really is. So what I asked these people is, hey, I'm not going to ask you to make any, I'm not going to have any obligations here. No pressure. But if I come across a company I think I'm going to invest in personally, would you at the very least like to see the deal flow and have the option of co-investing? I said, yeah, of course. Like, this is a market that's booming and has so much opportunity for disruption. I'd love to be able to invest in the next wave of innovation. So as I kept having those conversations, that list that opted in ballooned to over 100 people. So I'm like, okay, we have something real here. And we were getting scale. So I said, all right, if these are some of my potential co-investors, who are the other phenotypes I would want the opinions of and to be my co-investors? So I thought to myself, well, benefits consultant and brokers know this market extremely well. Yeah. Benefits leaders know this market extremely well. People from the carrier and TPA space and PBM space know this well. So I started to expand my phenotype. And within about 6 more months, that list balloons to over 200 people. I had a half dozen benefits leaders. I had dozens of benefits consultants and brokers of influence. And then, in there were those other phenotypes. So when I get that list over 200 people, I'm like, all right, this thing is real. It's scaling. But again, I have a very non-traditional background. And there's a reason I waited 8 years to pick a company to invest in, because again, people like me, executive recruiters turned venture capitalists, you get one shot to prove yourself. If you don't get the first one right, you're probably not getting a second chance. So I waited for the right one. And then I said, you know what? I have a really unique skill set and network, but there's also areas of the business that I don't know very well. And certainly certain parts of our ideal co-investors that I don't have access to in scale. So I reached out to 2 of my dream business partners. Okay. Luckily, we were lucky. They both were enthused by my idea. So Jason Perot was perfect because he had sat in a benefits leader seat at Boeing and AT&T for a combined 27 years. Wow. He was the buyer and had been the early adopter of a lot of these digital health solutions and sat on the advisory boards of a lot of these digital health companies. So he's seen a lot of what works, what doesn't work. And again, what themes, are working really well for employers. He's a founding member of EHIR. So he was enthused. Because of Jason's involvement, we actually have over 200 sitting benefits leaders that are interested in our group and a part of our group to help us evaluate these opportunities and also be able to give us feedback, honest, candid feedback of what their thoughts are. Then Manny has been the CRO at multiple digital health companies that have scaled. And even better, he spent a couple decades also as a broker consultant. So he spent over a decade at Hewitt & Associates, actually ran H&B for them nationally for his last couple of years there, was CRO of Bloom Health, which eventually sold in the exchange market, and was also CRO of Consumer Medical that sold to Alight for over $300 million, actually taking 0 venture capital dollars. Yeah. So it was a bootstrapped company. I believe Kevin Kiekefer is now part of Pareto. He comes from the consumer medical family tree. So anyways, they rounded out my lack of knowledge because we had the buyer perspective and the commercial go-to-market and health and benefits consultant perspective, and they brought their networks into the fold. So now couple of years after initially thinking about this idea, we have a network of over 500 industry executives that have the option of participating in any of our deals that we also can pull on for expert evaluation on that specific new company we're looking at. Because again, that group for Elon was great 2 years ago to evaluate whether One Imaging had a really good value prop. I would argue that group is not the best to evaluate companies in other markets. So we can kind of pick and choose from our 500 plus members to get the ideal evaluation group, expert panel for every individual potential investment.
So that army of like 500 expert panelists now. So you have probably diverse perspectives. You have people that are willing to invest in different types of companies. So in 2025, now that you've assembled this army, how has that changed the type of business that you're interested in the healthcare space?
Again, we have a very specific thesis at MVP, and that's why...
why don't you restate that thesis? I want to make sure we hammer that.
And that's why we're super selective.
Yeah.
Again, we're seeing what benefits leaders are asking for, and what they're asking for keeps, let's just say, getting more and more specific as the years go by. What I'm seeing is everyone, I don't care if you're a employer of 3 employees or you have 1 million employees like Amazon or Walmart, every single business is seeing their health insurance premiums rise at unsustainable levels. And it's impacting businesses of all sizes. So what we're hearing from HR and benefits leaders is, I need to curb my healthcare trend. And they're looking for opportunities to save money in areas of the health plan that are inefficient, that are riddled with administrative costs, and are not driving efficiencies within the healthcare system. So we are specifically focused on finding companies that save the employer money in year 1 post-implementation with guarantees on performance and at-risk pricing, where they don't make any fees unless they're saving the employer money.
Well, so give me a category that has a lot of inefficiency in your mind that you're seeing interest in solving for.
So again, I'm seeing multiple themes, but the one that we keep gravitating towards is high margin areas of a health system.
Okay.
So what's really interesting, and I don't know if this is controversial or not, but I've been to many industry events and I really try to listen to the speakers at these events. And whether it's large health systems, health plans, PBMs, pharma companies, they all kind of sing pretty much the same song. Poor us. We're making no money on Medicare. We're making no money on Medicaid. And we, against our will, are having to gouge our employer customers just to keep our razor thin margins that we can hardly operate a business under. Even though all of them are making record profits. And I would argue all of those organizations are bloated with administrative costs that are fairly unnecessary. So I also think those 4 types of businesses also will not acknowledge that they might be able to operate more efficiently and be able to operate with lower expenses. That is not something they feel is a requirement. So their only way of keeping their margin is to keep charging the employers more and more and more.
And so we're talking about this
inflection point where unless the benefits leaders of organizations band together and fight back, nothing can change, with the healthcare rising costs in this area.
Well, they have to choose different partners, though. That's the problem. And you and I were talking about this over coffee. The ACA structurally prevents a carrier from wanting to lower their expenses, right? Like with their capped margins, okay? So why would they have the incentive to try to drive down costs? They do not, okay? So employers then need to decide, do I want to do business with a carrier that has a disincentive for my cost to go down over time?
Or broker consultant.
Or a consultant that's only recommending these big 3s or whomever to me. Why are the question I think right now in 25 with a really bad renewal cycle that we're going through, I think we are going through it for the next couple years most likely. The question needs to be, why you, Mr. or Mrs. Broker, are you bringing me only these options? There has to be other options. I think we're starting to see the watershed moment in healthcare where people are really questioning what they're being offered or suggested. And they're saying, I need something else. Stop giving me this crap, right? So that I do think it's the employers, but it's the employers with consultants bringing those ideas to the table. Right?
Couldn't agree more. And I don't care if it's a broker consultant, a carrier, a PBM. the ones that are going to succeed long-term are the ones that are looking out for the fiduciary duty of their clients. That is what builds loyalty. So for the brokers and consultants and health plans and PBMs and other organizations that service these types of customers, if they are only looking in their direct market vertical and silo and saying, well, we're a Ben admin company, or we're a HR payroll company, or we are a care management company, and we do what we do well, but everything else, that's not our issue. The groups, the consultant brokers that say, you know what, it's my job to identify cost savings opportunities for my employer to drive efficiency. That is what's going to build the loyalty to be able to keep customers and grow business. Unfortunately, that's just not how things have been done, the last 20 years.
Well, so Norm, what do we do though? And again, we had this conversation over coffee. I want to rehash it here. The point solution fatigue and the fragmentation where these employers are just inundated, and their consultants by extension are the ones having to screen even before they get to the employer. There's just so many things that solve like a singular component of the health plan that it's very difficult to parse as an employer. What should I actually roll out? And then what am I paying for and getting nothing in return? So how does one properly screen for those? And what do we do about that fragmentation?
I think I first want to address the unspoken big issue in the market is, again, I've seen the point solution market develop over the last decade. And some of these companies did very, very well financially for themselves. Some of them went public, some of them sold for huge numbers, and the investors and the employees did great. But a lot of these benefits did not drive the intended outcome for the benefits leader. And many of them were well-intentioned, but sometimes version 1.0 of a specific sector doesn't necessarily drive the best results. It's almost like, well, why did MySpace not win the social network game? It's like, well, MySpace had to walk so Facebook could run. And there may be companies that disrupt some of these categories that maybe haven't driven the cost savings that we expected in mental health and diabetes and some of these other areas. So the first issue is, over the last 10 years, I would argue less than 10% of solutions implemented at the point solution level had driven the intended outcomes and driven the intended value. So you have a very skeptical benefits leader. And it's not as though only the vendors sold them on a bill of goods. Brokers and consultants recommended these solutions and got a commission to sell those solutions, as did ASO health plans, as did PBMs. Everyone wanted their pound of flesh, in the transaction, as a stakeholder. So the first issue is most point solutions didn't work that well. So the idea of creating and implementing another one at a 10% success rate is not a sexy option for
it's fool me once, right? Shame on me.
So first thing we need to do as an industry is really identify the winners, identify the companies that are delivering true value for the employers and driving as much utilization and exposure for those companies as possible. That's what's best for the point solution market, is to really identify the good actors and not recommend the bad actors. The other thing is disruption, and risk. I think the most simple area is finding those very high margin areas of a health system and carving them out. So we saw it in fertility, we saw it with surgery, cancer, and substance use with the Carums and Lanterns of the world. Now we're seeing in radiology with One Imaging. They're doing fantastic. We're seeing a new company that MVP is going to be lucky enough to invest in called Leap Health. They're doing a very similar thing in specialty infusion. Interestingly, over 50% of specialty biologics are done via IV. And that is one of the highest markup areas that exist in a health plan. It's one of the largest costs. 2% of a population can cause over 50% of their pharma spend.
I've seen one person drive a third of a company's spend because of an infusion in a hospital setting. $1.5 million a year for one person.
So again, I think the way to do this in bite-sized chunks is to implement certain service lines where the employers are getting price gouged and carving them out. That's, I think, the first iteration of this. Then it's the bigger sectors. It's new age PBMs, new age health plans, new age TPAs. that are driving better efficiencies and more cost savings for the employer. But those are bigger lifts, those are bigger risks, and those cause more disruption. So I think there's the intermediate, what can we do in the next couple years that becomes mainstream? And my hope is 5-10 years from now, the big 3 PBMs don't have the same market share they have today. The current big BUCA carriers aren't having the same market share as they have today. And by having that incumbent erosion over the next decade is what I think is our only hope for benefits trend to at the very least stagnate and maybe even decrease some, instead of the 10% increase year over year in which healthcare costs are doubling.
$27,000, the price of a new sedan. And in 2026, it's also the annual price of family health insurance premiums. We often talk about rising healthcare costs. The question is, what can we do about it? It's time to move beyond the traditional approach and take control of healthcare costs by considering an alternative health plan. With over 1,000 clients nationwide, Imagine 360 is a leading alternative health plan delivering direct contracts with top health systems and providers, reference-based pricing for fair, predictable costs, concierge member support, a fully transparent PBM, and third-party administrative services. And Imagine 360 is revolutionizing what reference-based pricing means today. They offer a comprehensive, transparent, and cost-controlled health plan. Most importantly, with average savings of 15 to 30% and a 98% member satisfaction score, Imagine 360 helps organizations reinvest in their business and their people. So if you're a broker seeking a differentiated solution or an employer ready to offer richer benefits at a lower price, contact Imagine 360 today. Well, so we do kind of a slide deck, and we show 9% trend over a 10-year period, and a 9% trend in 10 years is a doubling just based on what Rule 72 or whatever is. So you double
what, 5 years approximately?
If it's just 9%, by the 10th year, you've more than doubled your premium alone. And then the cumulative spend obviously is even worse when you look at it in totality.
In the stock market investing game, I was told this as an 18-year-old. It's like, well, if you just get 7%, every 10 years is going to double. So 9 would even be a little bit
9,
higher.
it's like $2 million of premium becomes 4.3 to be exact on the math. And so it's just when you show somebody that, everybody understands compound returns in investing. Employers have seemed to ignore the long-term cost of doing nothing, which is the compound increases of premium. And you just figure out how to manage the delta from year to year and massage that. But you don't look long-term and go, what is this actually doing to my business and the enterprise value of my business, et cetera. And so I think we're at the cusp, right, where there is the erosion of market share. I think you're splitting the risk pools where a lot of the fully insured market is going to be left year over year with the worse and worse risks, so the tarnishing of that risk pool. And then employers need to ask for better ideas and demand better options. But what I really want to get at is like, how do you cast the vision for what is the long-term version of a replacement health plan in totality, right? How do you get insurance to do what it does and cover catastrophic care? And then how do you assemble a functional, seamless, high-quality experience health plan that operates as a member or a user would want it to operate? And I don't think we've gotten quite there yet.
Well, I would say if I was able to fix that, I would have started a venture group by myself. But
maybe give me the key components that you would assemble.
So I think, again, and I don't mean to redirect the question, but I think the major issue is show me an incentive structure and I'll show you human behavior.
Of course.
The benefits leader has an immense amount of responsibility, but at the same time, they're not incentivized to take risks. The challenge is for a benefits leader, okay, some startup PBM comes to you and says, hey, we can save you 20% on your PBM spend. You get really excited. The question is, if you start getting month 2 post-implementation, a lot of complaints. Hey, I can't get the drug I want. Hey, I can't do this. I can't do that. This is a new system. You could be shown the door within the first year post-implementation and you lose your job. If you get it right and you do save your employer tens of millions or over $100 million, you might get a nice pat on the back. You might get a nice modest raise, but the risk doesn't outweigh the reward. So I would argue CEOs of large and small companies, financial leaders of large enough companies where that person has a large, loud voice, needs to create an incentive structure for their benefits leadership to take some risks and to try new things. That's first and foremost. And then when it comes to, all right, how do we get to a new model? I think we have to really identify the good actors, also expose the bad actors on who is really looking out for the fiduciary duty of their employer customers. And if you have health plans that are looking to incentivize themselves to drive down cost, you're starting to chip away, and you get PBMs to do this, and you get TPAs to do this, and these could be existing incumbents or they could be the new age companies. We just need to get a cultural zeitgeist in the market where everyone is incentivized to lower healthcare costs while still operating a successful business in that confines.
Yeah, and one of the problems we were discussing earlier is the consultants. I don't even necessarily think it's their fault, or they're working for a large agency. A lot of their profitability results from carrier bonuses and overrides. And you could...
And PBMs.
And PBM script per script fill fees and things like that. Where you go, okay, like we know those probably shouldn't exist, but maybe that agency doesn't exist without them, right? So you're asking them to displace a significant part of their revenue to do the right thing. Well, how are you going to replace that lost revenue? Because if doing the right thing means I've got to let 7 of my people go, well, is that the right thing for your business? You'd probably argue, no, it's not.
Yeah.
So if we want to create better incentive structures, you can't ask people to take a 50, 60% haircut on their business in order to do that, or their business fails as a result. So we're caught in between a rock and a hard place right now.
Yeah, and I think, again, what's working really well and what are benefits leaders gravitating towards? At-risk contracts. Companies that are willing to put their money where their mouth is and be held accountable for hitting certain metrics to earn their revenue.
Yeah.
So I would argue, in an ideal world, PBMs would make their money this way. Health plans would make their money this way. Health systems would make their money this way. Pharma companies where it's, hey, you're paying this, but here's what you're getting. And this is more valuable than this. And when businesses
but employers are going to come to you and say, well, just give me that health plan. Like everything you're describing, I want that, but like put it together for me in one thing, right? And that's where I think we need to get to the next echelon of where healthcare becomes something we all as a country agree we do the best in the world. I don't think anybody thinks we do that right now. It's you've got to be able to replace what I have that I don't like with something that's essentially a full replacement that has all the pieces that are doing what I want them to do, and the incentive structures are proper.
And that's way out of my scope, in the sky.
I get it.
Head. But what I do believe is this is the collective effort of many. It's why I believe the venture capital firm Manny, Jason, myself have started is going to be revolutionary. We're not effective because we're just the 3 smartest people in the health and benefits space. We're far from it. But collectively, all 500 of us combined and growing can make an impact that very few people can't. Just because of the scale and the scope of the amount of people rowing in the same direction. So that's what I'm trying, and I hope we're trying to incentivize and try to propagate, is more people who are trying to achieve this goal all band together, rowing in the right direction. Because again, we are trying to disrupt trillion-dollar markets with deep pockets, with lobbyists, and without a huge groundswell of grassroots support, we are not going to be able to turn the tide.
But all it takes is the buyers, the employers themselves, to make better choices. That's what it comes down to.
They need to know how much power they have. They forget they are the end customer.
Yes.
Large corporations are insurance companies, PBMs, health systems, pharma companies' biggest customers. So until they realize, hey, we have more power than we give ourselves credit for, we have more leverage than we give ourselves credit for, and it's about time we advocated for ourselves, because your business model should not be, oh, well, we're not making enough money in our other business units, so we're going to just charge you more. That can't continue. It's created the issue we're in.
Well, and the biggest issue is not just the rising costs, though, Norm. It's also the erosion of the quality of the benefits that are often offered to the employees as a result of the employer trying to obstruct the rising costs, right? Well, okay, let me just raise the deductibles or raise the copays or raise the coinsurance, or let's take that benefit away because I can't afford it anymore. So you get something that gets worse incrementally over time and gets costlier over time as well. free markets don't operate that way. That business should have failed if that was the value proposition you're offering over time. But insurance is set up in this completely different way that it's almost too big to fail and has all the lobbying dollars and crony capitalism behind it. So it can't fail unless the employers are choosing better partners. All right, so why don't we finish here? I usually like to ask for closing thoughts. We've covered a lot of ground, and I think it's not a surprise to me that you've been successful thus far. And your kind of vision that you're casting for what healthcare can be, I can rally behind 100%. And so I hope you are correct. But the folks that have listened to the show so far and they are probably getting goosebumps, hopefully. What would you say to them as they go about their day? What do you want to leave them with, Norm?
Well, what I'd like to leave them with is collectively we can make a huge impact. So my goal is to motivate people to learn what is out there. What new innovative technology and services are out there that are driving massive value for the employer. And be brave, think outside the box, take some risk, trust people that have nothing to gain outside of providing better service, better access, better care at a lower cost, and people that don't benefit unless they get the desired outcomes, get the desired results that we want. So again, put some pressure on your vendors, the groups that, who are your, biggest line items on your balance sheet, to just provide a better service and really look out for your fiduciary duty.
Yeah. You keep stressing fiduciary duty, and that's something I'd want to make sure employers need to be thinking about. What is their responsibility to their employees, right? To manage their dollars as a fiduciary, the contributions those employees are making, it obligates that plan sponsor to make the right choices on their behalf. And I think a lot of employers, whether knowingly or unknowingly, are in breach of that fiduciary responsibility right now.
Not intentionally.
No, I don't think so. But there will be a comeuppance, unfortunately, I think, at some point around that. And so we cannot miss how important that fiduciary responsibility actually is. So I'm glad you keep bringing that up, man.
Yeah, and it's team effort. Benefits leaders are under-resourced. They're stretched thin. They're asked to be knowledgeable about a market that is the most complex area of the U.S. economy. So I feel for them. I don't think they're set up to succeed in all cases, but this needs to be a high priority for CEOs and CFOs, and to be thought partners with their benefits leader. Give them support, give them resources, give them a little bit of guidance on how to negotiate with very intimidating resources like a health plan or like a PBM. So again, it's like empower your benefits leaders, support them, and give them the resources to really advocate on behalf of your employees. Because again, as a recruiter, in my just thesis is a company is only a combination of people. And if you don't treat your people right, it's very hard to succeed as a business. So again, invest in your greatest assets and resources, which is your people.
And hire better consultants. All right, that's the last thing I'll say. Norm, I appreciate you, man. This is really cool to get a chance to sit down and get to know you. I imagine we'll probably stay in very close touch over the next couple of years, and I'd love to have you back on, when we can look backwards and talk about the success stories of some of your investments as well.
I can't wait. And again,
and I think your influence will have a positive influence on the industry as a whole, if your thesis is correct.
The thing I just enjoy about doing this venture work, and again, we're in the early innings of it, is not the financial success our investors are having. Like, that's a great byproduct, but it's all the people we've recommended One Imaging or Posterity to and Leap going forward are thanking us. Hey, thank you for recommending this. Our customer or our employees, love it. They're getting great care at lower cost, and this is helping us offer better benefits because it's saving us money in a high cost area where now we can reinvest those dollars elsewhere. So it's very rewarding to see these people benefit from our recommendations. And my only ask of you is, when you come across companies that are driving real meaningful value, real ROI, real cost savings for employers, let us know, because whether we can invest or not, we want to advocate and really evangelize for these companies.